This example is a calculation that I think is the most complex calculation in Chapter 3 and is found in the second part of Chapter 3. So this involves the kiddie tax. The kiddie tax came about because years ago parents would attempt to transfer some of their earnings and wealth to their children who would either pay no tax on it or very little tax, or much less tax certainly than the higher income earning parents. So as a family they were paying less tax. And so Congress instituted this tax scheme called a kiddie tax. So if the child has only unearned income like interest income, the calculation is pretty straightforward, and it's found on the top of page 532 in the text. However, when the child has both unearned income, interest in this case, and earned income, then the calculations become somewhat more convoluted. So in the green cells, some pea green cells here, we have the given information of interest income and earned income. And then the gray cells are intermediary calculations, and then the green cell is the final answer, which is the tax liability on the child. First step, calculate the net unearned income. And I did that by taking the interest income for the child, $11,750 in my example, and I took out $1,050, and then I took out again $1,050. That second one is a standard deduction. Those values are given to us in formula in the text. We wind up then with the net unearned income, and I have it explained here, so if you want to watch the video a few times, because the calculations are somewhat complex, this will help to explain each calculation. Then the next calculation is taxable income. And the taxable income then is going to be the calculation of the total $11,750 plus the $12,400. And to that, we're going to subtract the minimum of the $12,000 standard deduction, or $350 plus the child's earned income. And $12,000 is the minimum in this case, so we would take the total income and take out the standard deduction of $12,000, and we wind up with $12,150 as the taxable income. That $350, by the way, is given to us, and it's 10% of the maximum limit of $3,600 before we have to make these extra calculations. So the $350 is given, and I have that written out to the right as well. Now we've got the taxable income calculated. We need to calculate the earned taxable income. And the earned taxable income then is going to be the taxable income less the net unearned income. And that's at $2,500. Okay, now that we've done that, it's time to, what happened to my, there we go. It's time to calculate the child's tax liability now that we have these preliminary calculations done. And this again is unique. These calculations are unique to the children, to the kiddie tax. Now it's true that this table is used to the right here, that I'll explain in a minute, is used for estates and trusts. But the fact that we're pulling in the estate and trust tax rate schedules on a kiddie tax, on part of a kiddie tax of unearned income, is rather unique. Also is unique is the fact that we have a 10% rate on the earned income adjusted for $2,550. So again, this whole tax scheme on the kiddie tax is unique. Okay, so let's first calculate the modified tax on the earned taxable income. So in this case, it's going to be the earned taxable income of $2,500, and to that we're going to add $2,550, which is given to us, and then we're going to multiply that by that 10% special rate, and we wind up then with $505 tax on the earned taxable income. Now, the second part of the calculation is going to address the unearned income of the child. And in this case, we need to use or invoke two of these tax brackets in the 2018 estate and trust tax rates because the income exceeds $9,150. So in calculating the first bracket at 24%, we're going to take the minimum of the net unearned income or the 9150, and from that we're going to deduct the 2550. And then once we get that, the minimum of I-7, which is the net unearned income, or the 9150, which is that right here is found on the table. This is that upper edge of the bracket of 24%, the lower edge of the 35% bracket. It turns out the 9150 is the lesser of the two. So we'll take the 9150 then and subtract the 2550, and that will multiply by 24%. All right, so that only taxes, however, and I have that written out to the right here as well. However, that only taxes all of the unearned income up to 9150. Now we're into the next tax bracket, and it's the amount by which that net unearned income of 9650 exceeds this 9150 that will multiply by 35%. So in this case we have 9650 minus 9150 times 35%, because that's the next tax bracket for the estate and trust, and that gives us $175. So that's the tax then at 35% of the amount of unearned income we didn't tax in the previous tax schedule. And this calculation is very similar to what we would use this method in calculating any marginal tax rate. All right, so now we have taxed the unearned income, we have taxed the earned income, and we just need to add these three components together, and we wind up with a total tax on this child's income for unearned and earned of $2,264. So yes, this is like I said, a convoluted series of steps. It's why I wanted to just take a few minutes to kind of break this out and explain it. And if you have any questions on the calculation of the kiddie tax, and again, this is the most complex when the child has both types of income, especially of this amount, that we have to use the 10% special rate on earned income, and then we defer to the estate and trust income tax rates on the unearned income. So if you have any questions, please let me know.